Csca. Explain why delivering a unique product or service is often more effective than competing to deliver the best product. Competing to deliver the best product often leads to feature escalation and direct comparison, which intensifies rivalry and increases costs. When firms compete solely on quality or performance metrics, competitors can imitate improvements, leading to diminishing differentiation and margin pressure. Customers may struggle to perceive meaningful differences, making price a dominant decision factor. This dynamic can erode profitability despite continuous product enhancements. Delivering a unique product or service, by contrast, emphasizes differentiation based on distinctive attributes valued by a specific customer segment. Uniqueness may arise from design, brand identity, customization, convenience, distribution model, or bundled services. Rather than competing head-to-head on identical criteria, the firm reshapes customer expectations and reduces direct comparability with competitors. Strategic uniqueness creates defensible market space and reduced price sensitivity. When customers perceive offerings as distinct rather than simply superior on common metrics, loyalty increases and competition shifts away from price wars. This positioning supports sustainable competitive advantage by building strong brand identity and limiting imitation. Csca. Demonstrate understanding of how competitive advantage can derive from industry position and/or firm resources and capabilities. Competitive advantage can stem from a firm's industry position, as described by external analysis frameworks such as Porter's 5 Forces. Favorable positioning, such as operating in an attractive segment with high entry barriers, low substitute threats, and moderate rivalry, supports higher profitability. Strategic choices regarding target markets, customer segments, and value propositions influence how well the firm is positioned relative to competitors. Alternatively, advantage may derive from the firm's internal resources and capabilities, consistent with the resource-based view, RBV. Valuable, rare, difficult to imitate, and well-organized resources, such as proprietary technology, strong brand equity, efficient cost structures, or innovative culture, form the basis for sustainable competitive advantage. These internal strengths allow firms to outperform competitors even within challenging industries and practice. Sustainable advantage often results from the interaction of industry positioning and internal capabilities. A firm must select an attractive strategic position and possess the competencies necessary to exploit it effectively. Alignment between external opportunities and internal strengths ensures long-term performance and resilience against competitive threats. Csca. Explain why an organization with competitive advantage should achieve higher-than-average profitability, for-profit, or higher-than-average efficiency and effectiveness, non-profit. For for-profit organizations, competitive advantage enables either lower cost structures or premium pricing, both of which increase profit margins relative to industry peers. A firm with cost leadership can sustain profitability during price competition, while a differentiated firm can command higher prices due to perceived uniqueness. Over time, these advantages generate above-average returns on assets or equity compared to competitors lacking similar capabilities. For non-profit organizations, competitive advantage does not translate into profits but into superior mission fulfillment. Advantage may manifest as greater efficiency in resource utilization, stronger fundraising capability, broader stakeholder support, or more effective service delivery. These organizations create higher social impact per dollar spent, reflecting operational excellence and strategic alignment. In both cases, competitive advantage reflects superior value creation relative to alternatives. Whether measured in financial returns or mission outcomes, sustained advantage indicates effective strategy, strong internal capabilities, and alignment with stakeholder needs. Without measurable performance superiority, claims of competitive advantage lack strategic validity. Csca. Analyze a given scenario, identifying and explaining organizational sources of competitive advantage. Scenario analysis begins with identifying whether the organization's advantage derives from cost leadership, differentiation, or focused positioning. The analyst evaluates pricing strategy, margin structure, market share trends, and customer loyalty indicators. Financial ratios, value chain activities, and industry positioning help determine whether performance differences are attributable to structural cost advantages, premium pricing power, or niche specialization. Next, the analyst identifies specific internal sources of advantage, such as proprietary technology, strong brand reputation, efficient supply chain management, superior human capital, or effective organizational culture. The sustainability of these sources should be assessed based on difficulty of imitation, integration across activities, and alignment with strategic goals. Finally, the evaluation links competitive advantage to industry context and external forces. A strong capability may only create advantage if it addresses critical success factors within the industry. The analysis should explain how internal strengths interact with competitive forces to produce superior performance, ensuring conclusions are strategically grounded rather than descriptive.